Hi everyone, and to this live webinar organized by FERMA, the Federation of European Risk Management Associations. My name is Tiffaine and I'm delighted to moderate this webinar on global risk and resilience. We will address how organizations can use the Global Risk Report 2021, which was released in January, as a basis for strengthening enterprise-wide resilience. I'm sure you're all familiar with the Global Risk Report, which is an annual study published by the World Economic Forum. It describes the changes occurring in the global risk landscape from year to year. And this year's report will be very interesting to look at, since the current pandemic has taught us that a hypothetical systemic risk can become a reality, and that we were insufficiently prepared and vulnerable. At the same time, we know that COVID-19 will not be the last pandemic or indeed the last crisis that will emerge. So this pandemic is forcing us to think how to deal more effectively with both expected risk and the unexpected ones. This pandemic basically puts resilience in focus, and to achieve resilience, collaboration is vital. That is why FERMA has made From Risk to Resilience its theme of the year. And we are launching today our campaign with this webinar. We will start this webinar with a presentation of the key findings of the report, and we will then move on to the panel discussion on building resilience. You will have the opportunity to ask questions to the panelists during the Q&A, which will follow. But you are, of course, welcome to leave your question in the chat box all along the session. So it's now my great pleasure to introduce our four speakers. Marsh and Zurich are partners of the World Economic Forum for preparation of the Global Risk Report. And that's why I'm very delighted to be joined today by Carolina Klint, who is a Managing Director and Risk Management Leader for Continental Europe at Marsh, and Eugenie Molyneux, who is Chief Risk Officer of Commercial Insurance at Zurich Insurance Group. From the risk manager side, I'm very happy to welcome Valentina Paduano, who is Chief Risk Officer and Sustainability Director of Sogefi Group, and she's also a FERMA board member leading on the topic sustainability. I am also welcoming Philippe Cotelle, Head of Insurance Risk Management at Airbus Defence and Space, who is also a FERMA board member leading on the topic digital. Welcome. So let's start the session by a presentation of the key findings of the Global Risk Report 2021 by you, Carolina.
Thank you so much, Tiffaine. I hope you can hear me now. So, good afternoon, everyone, and many thanks for giving me the opportunity to provide a brief overview of the 2021 Global Risks Report and the highlights and some of the themes identified in it. Thank you. If we could move to the next slide, please. So, as most of you will already know, the Global Risks Report is produced every year by the World Economic Forum with the support of Marsh McLennan, Zurich Insurance Group, and other partners. And the report provides perspective on major risks to global prosperity, including economic, environmental, geopolitical, societal, and technological risks. And that wide scope means that it's relevant to those in business, governments, and other sectors, really across all parts of the world. Many of our clients use it as a reference point for thinking about the emerging risk landscape, key threats, and how resilient their organizations are to them. This year's report highlights how the pandemic has dramatically put the spotlight on and exacerbated other critical global risks affecting businesses and society. COVID-19 has exposed the many disparities in healthcare, education, technology, and economic prospects. And it's really forcing society as a whole to start conversations over a more equitable distribution of resources. And one of the main focus areas in this year's report is resilience in the face of the pandemic. So if we switch to the next slide. We will be able to see how the report goes into deep dive sections on selected areas of concern. And one is the disorderly industrial shakeout. And in this chapter, it's highlighted how the pandemic has given fresh momentum to many of the trends already disrupting economic activity, and how businesses need to adapt and change in order to survive. All companies are under increasing pressures from inward-looking national agendas, greater market concentration, in addition to popular scrutiny and volatility. The conclusion of this chapter, in short, is that failure to respond effectively will cause long-lasting consequences for companies and for the society as a whole. Another area addressed is the changing geopolitical landscape, as the tension between US and China continues to heat up. Middle powers, which are states lacking superpower status but still play a very influential role in international relations, are increasingly forced to choose sides at the cost of diplomatic and economic consequences. The report also puts the spotlight on the widening digital gap, and the development here has really taken a quantum leap due to the pandemic and has caused a gap between individuals and across countries, which is really aggravating existing inequalities, polarization, and also regulatory uncertainties. And I think it's fair to say that those lacking access to digital resources and capabilities risk falling behind as a sort of digital underclass, which is a quite concerning development. In addition to this, the report also points out the rapid increase in use of algorithms as a concern, as they may reinforce existing biases and inequalities. The last but not least topic addressed is the severe impact that the pandemic has had on youth. Many are facing a difficult economic outlook and feel that they have been robbed of many opportunities and avenues of education, international migration, and employment. And this has led to a deep sense of anxiety, and many have increasingly voiced their frustration in the streets. If we look at the risk landscape presented on the next slide, please. So this is based on the responses to a global risk perception survey, which captured the views of almost 700 experts, business leaders, and policymakers worldwide. And what is captured here is the perceived impact and likelihood for each risk over a 10-year time horizon, using a 5-point scale to assess both the likelihood and the impact. And looking at the evolution of risk concerns over time, it's worth noting that prior to 2014, economic risks were identified to have the greatest impact in case they would occur. And I think it's fair to say that the financial crisis of 2008 impacted the view. But if you look since 2011, there is a growing recognition about the importance of environmental risk, and that trend has continued. And then from 2016, environmental, societal, and geopolitical risks have dominated the concerns, both in terms of likelihood and impact. And technological risks have emerged as a significant concern from 2018. And 2020, the results is largely a continuation of this trend, with environmental risks occupying most of the top 5 most likely risks in the next 10 years. And also, unsurprisingly, the COVID pandemic has heightened awareness regarding the widespread impact of infectious diseases, which, as you can see, is ranked first in terms of impact this year. So you may look at this and you may wonder, why should we spend time on reviewing colorful boxes on a page? And why is this report relevant for business? And is it reliable? So if we switch to the next slide for a quick perspective. In the 2006 edition of the Global Risks Report, this statement was made. If person-to-person infection were to become commonplace, the vulnerabilities of our interconnected global system would intensify the human and economic impact. A lethal flu, its spread facilitated by global travel patterns and uncontained by insufficient warning mechanisms, would present an acute threat. the impact on society might be as profound as that which followed the Black Death in Europe in 1348. That plague caused a fundamental transformation of socio-economic relations in Europe. Let that sink in for a second, because I think in a way, of course, when the financial crisis hit, the attention was pulled away from the statement made in the Global Risks Report of 2006 and pulled away from the risk of infectious disease and in a different direction. But I will say, though, I think this section alone, highlighted here, really puts the spotlight on why the report is definitely worth reading. So that's a little bit of promotion of the report. If we shift gears slightly and focus on the implications for business, if we could switch to the next slide, please. One more. Good. So let's take a quick look at the data collected through a follow-up executive opinion survey. And this had responses from 12,000 business leaders from around the world who were asked to give their opinion on the top 5 global risks of doing business in their country out of a total list of 30 risks. And as you will see, in Europe, the spread of infectious diseases and the associated economic risks, such as unemployment, fiscal crisis, are the main areas of concern for executives. And as you can see, European executives are also very cautious about cyber risks, which I think is actually pretty good to see. Environmental risk only made a top placement in Iceland and Hungary, but I suspect that this will possibly change over time. So we can move on to the next slide. I wanted to focus on a couple of items specifically impacting business. Human risks. If we put it this way, 2020 proved to be the emotional equivalence of a marathon, and the report really picks up on a range of COVID-19 health consequences. And maybe most complex are the negative effects on mental health connected to lost schooling, altered work conditions, job losses, isolation, and the economic downturn. And I think that businesses need to recognize that their employees are human beings and pay attention to the mental health risks from the ongoing pandemic stresses. So really be prepared to provide their people with programs and tools that remove any stigma associated with seeking help and strengthen the long-term physical and mental well-being. We see companies are more and more transforming their organization work design and aligning new technologies and skills, focusing on cultivating health and well-being and building a more human-centric leadership culture. So companies may actually be able to use the pandemic as an excuse to create friendlier workplaces. And I think we also need to realize that the pandemic has shifted the priorities for young talents when making job choices. I read in a report that focus went from short travel time and mentoring in 2019 to wanting remote work and flexible hours in 2020. So that's definitely something to pay attention to when thinking about how to attract the new generation. Digital risk. The report highlights how the rapid switch to remote working that we all lived through has resulted in increased cyber exposure and more complex and potentially less secure networks. And the importance of cybersecurity has increased and it will continue to increase. We see attack rates going up, significant spikes in fraud attempts, greater volatility, and just looking at comparing the second half of 2019 to the first half of 2020, in the early days of the pandemic, the volume of cyber attacks doubled. So what is important here is that businesses should now take the time to assess the changes that were made in the heat of the pandemic and verify that the right investments have been made in networks and controls, and make sure to take the time to close any security and governance gaps that might remain. And the last point that I wanted to touch on is one of sustainability. And the motivations for companies to focus on sustainability and ESG comes from all angles. And the correlation between good ESG companies and their performance is becoming more tangible. Many private equity and fund managers are actually only looking at sustainable businesses to invest in. And at the same time, regulators and policymakers are implementing more performance-related requirements to be considered sustainable. And in addition, customers are becoming more aware of sustainable production, supply chains, and the Global Risks Report highlights this increasing stakeholder capitalism. And more than ever, I think it's fair to say that consumers, employees, investors expect companies to reflect their values. If it's from company ethics to inequalities to climate change. And I think it's clear that businesses have to take a firmer and more active stance in these questions to avoid negative impact to their revenue or reputation, or even access to talent. So companies continue to face extreme COVID circumstances, still, of course, need to make quick tactical decisions. And with that, the present is often prioritized over the future. But when possible, it's important to balance responding to the crisis in the short term while working to increase resilience to other risks facing business and society in the longer term. And I think sustainability actions can be leveraged to navigate the crisis while building resilience and long-term value creation. I have added an appendix to the presentation on the next couple of slides for some ideas on how to approach risk management and risk assessment against the backdrop of the themes identified in the report. And happy for FERMA to share the presentation to all participants so that you can take a look. And with that, I look forward to the panel discussion, and I will hand it back over to you, Tiffany.
Thank you very much, Carolina, for this very interesting presentation. So without waiting, I suggest that we turn to the other panelists to get their perspective. So maybe, Valentina, if I can start with you first. So what does resilience mean to you and your organization? Are there any particular lessons from COVID-19 that you might want to highlight?
Thanks, Stephen. Resilience, in my opinion, is linked to the company ability to be flexible and reactive, not necessarily to negative events like the pandemic, but in general to the changing context. Think about, for example, of such technological innovations that are requiring a resilient business model. That means to have a business mindset ready to evaluate any new coming opportunities and risks and translate them in a new way to do business. So this is a resilient approach. Thanks to the risk management process and the periodical discussion and benchmarking within the organization and the top management on potential risks of different nature, during the last 10 years, more or less, we learned to be resilient. We learned to think out the box, to challenge the reliability of our company processes and strategies, of course, with a great cultural effort of our managers. And the 2020 pandemic confirmed that companies with a consolidated risk management have been more reactive to execute the crisis management, reducing the negative effects on the business operations. Based on my experience, there are two main examples demonstrating the company resilience thanks to the adoption of a risk approach. And by the way, they are two risks we can classify as ESG risks. The first one is related to the occupational health and safety of all employees that required the rethinking of operational way to work. So company had to evaluate in few days, a few weeks, based on the different activities performed by their employees. So, for example, distinguish from workers in production site with a higher infection risk compared to the white collar. So they had to evaluate the adoptions of different rules and protocols, also in compliance with the local regulations, or, for example, evaluate the adoption of the applicability of the smart working. So companies that have been able to adopt those actions very fast ensure the safe working conditions without affecting the daily operations. The second example is related to the supplier risk. During the pandemic, and unfortunately the situation is not yet changed, a lot of small and local suppliers suffered the economic crisis. and their sustainability has been hardly tested, sometimes leading to some partial or temporary interruptions, as well as to impact on the quality of the materials supplied. Companies have therefore been forced to review and adapt their supplier portfolio in line with the current needs, in particular by strengthening the process of supplier selections and monitoring in order to ensure a timely assessment of both financial solidity and adherence to adequate quality standards, and by identifying, of course, where possible, alternative suppliers for the most critical raw material or components to reduce as much as possible the possible risk of dependence from these suppliers. Only companies that have been able to quickly react to this situation confirmed minimum effect on their business operation, finally demonstrating the added value of the risk-based approach.
Thank you, Valentina. Philippe, what is your view about it? Do you consider that the world after the recovery, which we hope will be hopefully soon, will come back to the situation where we were prior to the crisis?
Yeah, thank you, Tiffen, and welcome to everyone. The crisis we faced is clearly unprecedented, and to some extent, regarding the way the companies had to cope with that situation and literally run into a digital mode as soon as possible in order to preserve as little activity as they can in the quickest way as possible, is clearly a good example of what Valentina explained about resilience. However, and the results were spectacular. Public authorities in France demonstrated that at least 25% of active workforce were working home, which is absolutely amazing. 50% increase on e-commerce and on digital transfer payment. That's absolutely awesome. However, such a situation is there to stay. The world will never be back to the situation we were before the crisis. And this is really something that we have to learn as well. I mean, the steps, it was a kind of a quantum leap to some extent in digital trend. And the society has changed. The way of working has changed. CFOs have been delighted to see that travel costs reduction does not really impact so much in terms of work efficiency. And therefore, it's something which, will there to stay. The way of consuming has evolved significantly and will be there to stay at all scale of the economy. And this is also a very important element. However, when we did this sort of change, such a drastic change in a crisis mode, had for consequence that some of the companies had to do some compromise, let's use that word, in terms of security. And we have now a situation that on one side, companies are more depending on digital than before, meaning that should there be an issue, the cost to the company would be increased compared to before because they are more depending on digital for their work and because the way of consuming has evolved as well. So that's one aspect. So exposure related to digital has increased significantly. And at the same time, companies have had to do some compromise, let's put it that way, to cope with these new needs. And so the environment of threats, and Carolina mentioned that very well, has evolved as well. And we see a new trend about an increased number of attacks, just because, the attackers are taking benefit of those compromises that were done on some companies. But let me be clear. This is not something which is just happening on a general basis to all companies. We really see a gap increasing between the companies that were prepared before COVID and were mature enough in terms of managing digital risk before COVID, and which were able to manage this compromise section during the crisis phase in such a way that they were not facing too much of an issue, and the number of attacks on those companies has not raised dramatically. On the other hand, the companies that were not ready beforehand, and maybe the smaller ones, then the choice that they had to cope in terms of increased digitalization in an uncoordinated manner has created for them what I would call a security debt. Security debt implies that they are currently, because of the surface of attack that they have, that has increased significantly, because the change of use, the change of work, has for them a significant cost to incur in the future in order to restore to a situation that they should have been before the crisis. And that's where the gap is increasing, and that's really a concern globally for the future of the economy. And I'm sure, Tiffany, we will come back on how to mitigate that and how why risk management is so important. And also, Eugenie will be happy to see how insurers have a role to play on that basis.
Thank you, Philippe. And now I'm turning to the insurers, so to Eugenie, then it's a good way to change speaker. So Eugenie, basically systemic risk, like COVID-19, but it can be a massive cyber attack, as mentioned by Philippe. It can be terrorism and so on, are hard to quantify. So does it mean that historical insurance data models do not work in our current environment? What are basically the key lessons that the insurance industry learned with COVID-19?
So firstly, I'd say, I'm not sure this is an insurance industry issue. You've got to remember, we take on the risks of other companies or other individuals or other organizations. And so in many respects, the risks we're taking on are risks that those companies are facing in the first place. And so I think it's probably the learnings for all of us in this. And I tend to take a bit more of a commercial focus given my background. Yes, the risks can be difficult to quantify. I'm not sure it's about the risk itself, but because of the interconnected nature of the risk landscape, that was one of the things that COVID-19 really highlighted, was the knock-on impacts of the pandemic and the vulnerabilities that it exposed to other risks. So I think the difficulty in quantification is due to the risk landscape itself. And if I might add to some of the things that Carolina said earlier, when you look at the global risks landscape, there are 35 risks on it. There were 30 last year. So we've technically only an increase of 5, except that what's happened is we've aggregated a number of the risks. So things like food crises, water crises were combined with natural resource crises, so minerals and the like, to form this new metric, natural resource crisis. So in some respects, what that's demonstrating is the risk landscape is getting more intense. There's more risks on it. And because of the interconnectivity, the greater difficulty we have in quantification. The other thing I would say is some of the risks that were added, things like geopolitization of resources, so to Valentina's point about resource availability through supply chains, are new risks because of the intensification of some of these that we saw during COVID-19. So yes, the quantification is difficult in this circumstance. Added to that, the other thing we need to be aware of is on that risk landscape, different risks become different critical threats at different times. So what Carolina showed us was sort of long-term view, right? But actually, if you look at some of the medium-term touch points on the way through, we actually see the risk landscape changing. And the problem is with some of those risks, they actually need to be managed today, or you need to do your risk assessment today to prepare to mitigate for them when they arrive in the medium term. So coming back to the questions that you asked, I think then it's very important for risk managers to see that bigger picture, including the direct and indirect risks and including the timing And not just say, well, okay, it's occurring later on, therefore I don't need to worry about it now, but you need to think about how long it might take to mitigate some of those risks. And to understand, so when you're doing your quantification, what you might need to be doing is looking at trends, scenarios, tipping points, yeah? So you can take historical data, but the question is it relevant to today's situation or indeed even tomorrow's situation? So you take that data and you basically need to adjust it for some of those things like scenarios, like tipping points. So if I use an example that probably ties into the quote that Carolina pulled out for us in relation to the 2006 Global Risks Report. If you were basing your risk assessment to a pandemic based on, shall we say, the experience of SARS, MERS, Zika, something like that, yeah, an adjustment was necessary because since 2002, travel between Asia and the rest of the world has increased by a factor of around 10. So coming back to that point they made around the greater interconnectivity of the world, yeah. Also, if we remember, China was hit first. Well, China has increased from 4.5% of the world's GDP to 18.5% of the world's GDP. So it's far more critical to our supply chains and trade generally around the world. So a bigger impact results from the disruption from China to begin with. And then, of course, we saw that knock-on impact generally around the world. So yes, you can use historical experience, but you do need to update it for the current environment or even indeed future trends and pay particular attention to tipping points. Now, that can be quite difficult to quantify. So in some respects, using extreme scenarios can be a better way of looking at this, to test your risk tolerance boundaries, almost say, what are we willing to put up with, yeah? But I think probably the most important thing is to act on all of those insights.
Thank you, Eugenie. Very, very interesting. Carolina, I'm coming back to you. Do you agree with Eugenie that, you know, the experiences of the past year basically have changed, you know, how we think and at risk, at resilience, and the you know, the processes that we use?
Yes, absolutely. I absolutely think that the pandemic has changed the way we think about risk, because I think we all had an opportunity to learn firsthand that these low frequency, high severity events do happen and that their impact can be quite sudden and also quite serious, severe. So, but I also think that we gained a better understanding of how risks are interconnected and how they exacerbate each other. That's the other thing. And the pandemic has accelerated trends that have been coming for a long time. And we see many businesses are grappling with how to survive and build resilience. And it's not only in relation to the ongoing pandemic impact, but they also have to cope with an increased number of cyber attacks, extreme weather events, increased public scrutiny. So it's a complex environment to operate in. And one recent example that I picked up in local media here in Sweden is that the largest manufacturer of glasses and contact lenses in Scandinavia, they announced that they are moving their entire production of glasses to Sweden, and they're closing down the factory in China. And my initial reflection was that, okay, it's to reduce supply chain vulnerability, but then I did a bit of digging and there was more to this decision. It wasn't just to secure the supply, but the maneuver was also part of the investment in sustainability. And the company believes that the Nordic customers will reward the strategy. By moving production to Sweden, they will reduce transport needs, they will make it easier to work with the local recycled materials. And that way they address both the supply chain risk, but they're also addressing the environmental footprint and the growing urgency of stakeholder capitalism. So I think it's such an interesting example of the complexity and also the company paying attention to emerging risks and how they review strategies and exposures and then adjust accordingly. And something else that I've been thinking about and actually connected to Philippe, you used the word security depth. because I think maybe in the past times we have rewarded efficiency over resilience and growth over sustainability a little bit too much. And I've been thinking about maybe we create the resilience debt by not responding to and preparing for emerging risks. Because if we think about it for a second, the past decades, the relative predictability of the business environment has enabled companies to pursue efficiency that has helped fuel exceptional profit growth. But the focus on efficiency has also left some companies too lean and much more vulnerable to shocks. And maybe it takes a little bit more slack in the system to achieve that needed long-term resilience. And another thing that I want to highlight is that this past year, one thing that has changed is that thinking and talking about risk is suddenly more popular. So, and also now in the midst of COVID-19, more executives are open to investing in their business resilience. So risk professionals have suddenly got a very clear seat at the table, and there's a better understanding of that risk management is in fact fundamental to ensure sustainability and resilience. And I think that's a good development for all risk professionals. So in summary, I think it's fair to say that 2020 left us with a renewed appreciation of risk and resilience. Thank you.
Which is definitely a good news, but also a challenge for the risk managers, of course, to take up. So, and you also mentioned that companies, are under enormous pressure, basically by all stakeholders, to do something about, sustainability and climate change. And I'm turning to you, Valentina. So we've seen in the report that, climate action failure is one of the world's greatest challenge in the next 5 to 10 years, both in terms of impact and likelihoods. But it was already the case also last year and in 2019. So in your views, why is it often difficult to translate this into action? How do you explain this disconnect? And maybe linked to this question, how can risk management help to create resilience to climate change?
Ifan, let me start saying that the key word is failure. The main highlighted risk in the global risk report is not generally related to the potential consequences of the climate change, but it is related to the fact that the recent financial crisis and the difficulties that companies is facing up will likely determine the reduction in climate change investment and the consequent failure of activities already performed as of today. In 2020, as the non-financial disclosure report that are still under finalization will confirm, it is expected to record a fall in the global emissions. But it is just a temporary effect, mainly due to the lockdown period and the consequent temporary stoppage of production activities around the world. So this means that the trend could bounce back when the social and economic situation will be back to normal. Let me also add that this failure risk is affected by the perception that actions and strategies of local government around the world are not coordinated and committed to the same reason. Just think, for example, of the US approach to climate change during the Trump presidency is completely with an opposite vision of the European Commission, and that has been only recently straightened by the new president. So I think that this is an important message which the governments should be aware. Then going to your second question, so how can risk management can help to create resilience to climate change? What emerged from the discussions with the risk managers of our FERMA network is that sustainability, in particular the climate change, is a target that must be necessarily included in the company strategies. There is a green wave that is affecting all business operations. So companies are now interested to understand how to reduce these impacts on their activities. And let me say that the risk managers is the more qualified role within the organization can help the company to find and evaluate the risk associated with that. Through the risk management, companies learned to have a risk-oriented focus on their operations that increase the business resilience, as already said, to any negative events, and also demonstrated during this pandemic. The same can be for sustainability and the climate change. With FERMA, we are working a lot to promote the integration of risk and sustainability management within the organization, moving away from the traditional compliance approach. In concrete, the resilience to climate change can be supported by, for example, the creation of a common language. What means climate change? What are the climate change related risks? And so on. So clarifying these kind of questions within the organizations. Or by setting regular reporting to the top management and the board of directors about the topic, arising the strategic perspective of the climate change risk and of course also of all other ESG risks. And finally, by improving the cross-function collaboration and consequently increase the awareness of climate change within the organizations. So just to conclude, in the next weeks, FERMA will launch a guidance dedicated to the integration of risk and sustainability that, let me say, I suggest to read when it will be ready, because I think that I'm sure it will help our colleague to go in the right direction in this journey.
Thank you, Valentina. Philippe, so we focused on climate change, but if we go back to cyber and technological risks, so we see it remains very high on the agenda of businesses. So do you feel basically that cyber risk is going to be the next pandemic? And are public authorities anxious about that?
Well, I hope that not all the people who are listening to this webinar will be that anxious after the webinar. So I'll try to moderate that a little bit. But what is interesting is that we see resilience in two dimensions. Of course, climate change is clearly a topic, but it's still perceived to be a sort of mid-term target. We always say what needs to be done now to improve the situation by 2030, by 2040 or 2050, which can be perceived a bit long-term. On the same time, they have also cyber exposure, which is happening today. I mean, tomorrow the company can stop working. I mean, that's not in 10 years' time or 5 years' time, it's tomorrow. And the risk management role is clearly a key asset on that, for both trying to combine this long-term view and to have this strategy going forward in order to address that midterm objective, which we have to cope, and every company has now to drive that, but also facing this short-term issue, will the company be able to work tomorrow? And that's really something which is interesting, because it gives to the risk manager the perception that you need to be practical concretely now, but also with a long-term view. So to combine short-term action with long-term action together, and to make it globally consistent. So what a target. Coming back to your excellent question, Tiffen, about the pandemic, it's not really the pandemic per se, which I think is really the issue. The issue is more that this digital step has been taking place for all the companies of all sizes and all sectors, whether they were ready or not. The point is that they are probably not all aware about the new exposure they face, about the new threat they have around them, and they have maybe not all the expertise to conduct it accurately, and maybe not also the right insurance coverage. And just maybe to come back on that, because this is really an important element. If those companies are now suffering an attack which can be not systemic, but maybe a large attack or an attack on a number of entities, they would be left without any solution because of the lack of expertise, the lack of readiness, and to some extent the lack of resource to cope with that and the financial support they need to sustain. Public authorities are much more aware today of that threat than before, and it's clear that, for example, in France, at Amare, we have been consulted by French public authorities who are very concerned about that potential threat because, I mean, economy is facing a crisis globally, and for those entities who are maybe already fragile because of the crisis, to invest into security at that time can be a significant issue. Then your next question maybe, and coming back to Eugenie, what is the role of insurers? And insurers are playing a role already, and quite well. Regarding the climate change, so NatCat exposure, I mean, insurers have been able to develop solutions that are efficient and demonstrate its efficiency all over the world, and they continue to that. And reinsurance market, as well as insurance market, has been able to deploy that to manage this exposure, this evolving exposure, in a way which is today still able to respond to the issues. Regarding cyber, the picture is a bit more dodgy, if I may say so, Eugenie. I mean, let's face the situation from last year. Yes, cyber insurance is a tool which is working, and we need to insist on that. We got the Association of British Insurers who released a number of 99% of claims had been resolved positively up to the level of the amounts that were insured. So that demonstrates that cyber insurance is a tool which is working. However, it's a tool which is sometimes complex. That's why at FERMA we were aware of that, and we anticipated that from quite some time. That's why in 2018, for example, FERMA worked and released a report with Insurance Europe and BIPA, because we were convinced that it was only by working all together on the same table that we could improve the quality of dialogue between insured and insurer in order to make sure that we have a sustainable situation. Fact is that we face today a situation which is not that sustainable. And as I expressed, the companies are facing a significant increase of exposure to digital. And at the same time, cyber insurers are to some extent reducing their proposal, reducing their offer. So we have a kind of a seesaw effect where we can really see a number of companies left alone on a risk that they will continue to carry because digital is there to stay. So yes, this is a concern, and this is why, I mean, companies have to be aware, have to be understanding such exposure, but also we need to sit down with insurers and public authorities in order to incentivize risk management, demonstrate the value of risk management, but also have insurers to continue to play their role in this, because this is really how they can demonstrate how they support the transformation of the economy, which we see as a space that has never been seen before.
Eugenie, would you like to respond to Philippe?
Sure. So let me just start with, the insurance industry absolutely sees the need to help its customers be more resilient. Yeah. In this, interestingly enough, the insurance industry and the customers are aligned. The more resilient the customers are, the better risk they are from our perspective, and therefore the more likely they get the coverage they need and want from an insurance perspective. Yeah. What I would say is, over time, we are developing services beyond just the insurance product, because it does matter that the companies themselves are resilient, particularly in the areas of climate change, cyber, and also supply chains, which have been sort of three hot topics through today. So I do think that's important. One of the things that's kind of interesting about the current paradigm that we're in is that what COVID-19 did was lay bare that some of the risks that companies were taking because they had, for example, say just-in-time solutions and the like, no company or industry could withstand alone. Yeah. So it required government interventions to keep the economy going, for example, right? Now, there are some takeaways around resilience. What we saw is companies that were, say, diversified in terms of their products and services maybe performed better. Companies that had diversification of distribution channels, so they were already online, didn't have to build that. I think it was Carolina referred to it earlier, a 50% increase. And similarly, diversification of supply chains, or even just redundancy in their parts and supplies. But the last thing that we did see is that companies with strong technology capabilities were able to adapt faster than others, move to working from home. The problem with all these very good resilience practices is they also come with trade-offs. Yeah, and so particularly for cyber, one of the trade-offs for working from home and having that capacity to work from home, so being responsive then in something like a disruption from a pandemic, or it could be climate change, or it could be, you know, social risks or geopolitical risks even. It comes with increased vulnerability because everyone's working from home. Yeah. So there's no doubt that we do, if we want to, shall we say, be resilient to one risk, we do need to make sure that we're not creating a vulnerability with another risk. And similarly, even if we say, yes, we're looking to, you know, we should support our customers in finding ways to diversify their products, their supply chains, their distribution channels to support their own resilience. Again, that comes with costs. And in a world where some companies are being incentivized to nearshore their operations or onshore their operations and their supplies. Now, from that perspective, depending on where you are nearshoring or offshoring to, you're then potentially exacerbating a risk again to, it could be socio-political tensions, it could be to climate change, you know, weather-related events emanating from climate change. So I do think it's very important for insurers to go beyond just the provision of the insurance product. I think we as an industry acknowledge that and are trying to provide those services. I think beyond that, I think probably the slightly more interesting paradigm for companies today, what we saw through the financial crisis were possibly some expectations around excess financial capacity. So at the beginning of the pandemic, sorry, I said financial crisis, but pandemic, at the beginning of the pandemic, just a couple of weeks in, we saw companies asking for government bailouts in order to avoid mass layoffs. And yet in the lead up to that point in time, they had been showing profits in prior years. So naturally, we're seeing the question asked, well, hang on a minute, shouldn't you have been more resilient? Yeah. So I do think there is also going to be a question mark around financial resilience going forward for a number of companies, particularly the larger ones. You know, it might look something along the lines of, we expect you to be X months resilient. I don't know what X is, but let's say it's a couple of months. So within that, in a scenario like that, then you have the government doing its part, the insurance industry doing its part, you have the companies themselves doing their part, creating, shall we say, a greater overall resilience.
Thank you, Eugenie, and I think we could continue the discussion on this topic. But I think I'd like to move now to the audience discussion because by looking at the time, I'd like to take, you know, the remaining 5 minutes to go through as many questions as we can. So I remind you that you can, you know, it's your chance to submit questions using the chat box. So I see that we have already a couple of questions. So I will start, Carolina, with you. The ranking of the top risk has changed dramatically after the pandemic. So do you foresee a reversion to more normal ranking of risk soon? Or do you see a pandemic type risk hanging around for long term?
I think that's a great question. You know, I think it's not only COVID-19. I mean, and actually, if we take a step back and I don't remember who it was, but someone mentioned it before. COVID-19 wasn't the first time we were hit by infectious disease. We had near misses with the swine flu and the bird flu, which then didn't turn into global pandemics, but COVID-19 did. And again, we can learn that low frequency, high severity events do happen, and they're not just scenarios for a tabletop exercise. But to the question, I think the next time it might not be COVID-19 or even, you know, infectious disease. It will probably be something else, like a cyber attack or an extreme weather event. I mean, if we look at the way that the risk concerns have evolved, I would think that it is either in the cyberspace or in the climate event space that we'll see the next dramatic threat.
Thank you. Another interesting question. So, are we in danger of focusing too much on risk and not enough on opportunities? And in your view, what is a key area to turn into an opportunity in light of the pandemic? Maybe Valentina, you'd like to take this one?
Yes, absolutely. But I think that one of the main lessons learned during this we had during this year is that, of course, the negative events reflected a lot of positive changes within the organization, starting from the new way of work that only the large companies have experimented in the past, for example, the smart working, but during the pandemic, we had the opportunity around the world for all companies to adopt this kind of new way of work. This means that Hello has a new balance between the private and the professional life. So this is just one simple example. But in any case, we also learned to the fact that some remote events can occur, and companies in many cases demonstrated to be able to react positively to these negative events. So this demonstrates that when we need to change, the companies are ready to do that. I think that can be read as an opportunity also for the future in order to break some wall, cultural role with regard of the possibility to change the way of work and the possibility to change the business model in general. So everything can be read not as a risk, but as an opportunity. Absolutely, and the same is for sustainability perspective, of course, because we are speaking about climate change failure, but of course the climate change is a big opportunity for the future, for the next generation, and for the environmental in general effect on the world. So there are a lot of opportunities.
And digital is really the opportunity. Just look at what we are doing now. We are in France, Italy, Belgium, Sweden, Eugenie, I don't know where you are, and we are by worldwide people. I mean, that's just great. That's such a great opportunity.
Indeed. Another question, probably to Eugenie or Carolina. In what ways do you see rising income inequality affecting companies? Would like
yes,
to take this one.
Sorry,
Eugenie.
that's you want me to take that, or Carolina? Yep. I think that's a great question. I think companies are expected to be more socially responsible than we've seen in the past. And I think that's why the question mark has come up around, well, why are they looking for bailouts when, you know, they're making profits, but they need the bailout to support staff. So I do think income inequality, because it plays into social cohesion or the increased risk of a lack of social cohesion and therefore disruption to the business. I think, frankly, it's in the best interests of companies anyway to consider income inequality when they're looking at the landscape of their risks and their role within that. Yeah.
Carolina, would you like to add anything?
Well, I think what I can add is just plugging the importance of diversity as we build back better, because I think that's really part of sustainability and that sort of social responsibility. I mean, it's important to recognize the fact that diversity improves the quality of decisions. It reduces the risk of groupthink. It helps companies better understand and reflect the markets they serve. And putting that gender and broader diversity balance high up on the agenda is a way to safeguard relevance and resilience against this backdrop of a constantly changing economy and world. And I think it's important to recognize that it's not only about building resilience and doing the right thing, it has a business purpose as well. So that's what I would add on that topic.
Thank you very much. I see that time flies. So, well, we could be there for I think a couple of hours again, but unfortunately we have to end the webinar. And clearly the discussion have shown that building resilience has never been more important. We have to seize the global picture. We have to be able to not only respond to adverse events, but also to seize the opportunities and with confidence. And this is what innovation and entrepreneurship is about. So I also noticed some keywords that you mentioned. I think there was a keyword is anticipation. So to anticipate, to have an early warning system, to prevent, to protect, to prepare, and then here risk management is an essential element to it. Agility, of course, to respond to the adverse events, but it's diversification of suppliers, resources, assets, robust and flexible infrastructure also. The keyword rapidity, important to have a rapid response to recover quickly. So it's about, processes, governance, having the capacity to take rapid decisions, and communication, of course. So it's about having clear communication lines internally, but externally also, being able also to cooperate with partners. So yeah, I think resilience is a topic that we will be discussing throughout the whole year. I'm very grateful to all our speakers for having shared your insight on this imperative for resilience. And following this session, you will receive the replay of the webcast as well as the slides. If you are a REMAP certified risk managers, don't forget to log on your 2 CPD points for attending this webinar. And thank you to all of you for joining. So we'll be happy for you to join our next webinar, which will be on the 31st of March. And it will be the launch of our sustainability guide that Valentina mentioned. So we really encourage you to be with us on the 31st of March. Also, save the date, because this year we have the FERMA Forum. It's taking place from the 10th to the 12th of October. So thank you again to our brilliant panelists for this very interactive and interesting discussion, and see you soon.
Thank you.
Thank you. Bye-bye.
Thank you.